Today's episode features Zack Porter. Zack is one of the founders and a vice president at Boa Safra Ag Services. They specialize in legacy nutrient deductions, which is a really neat opportunity and kind of a newer tax strategy that a lot of our clients and landowners throughout the country are starting to utilize. And so I appreciate Zack coming on. Nothing that you hear in this podcast is tax advice, legal advice, anything like that. If you have an interest in pursuing a legacy nutrient deduction, please consult your own CPA, your own attorney, have them review this tax deduction, have them review the work that Zack and his team produce. It's everybody's individual decision on what to do, but we wanted to give Zack the opportunity to inform landowners about this, about their company, and some of the potential benefits to it. But again, nothing in here is legal or tax advice, and please consult your own CPA about these opportunities. And with that, we'll get into the podcast.
In Our Expert Opinion podcast is brought to you by Saunders Real Estate, the Southeast's leading land and commercial real estate firm, helping clients make bold and informed investment decisions since 1996.
Good afternoon and welcome to another edition of In Our Expert Opinion podcast. My name is Tyler Davis. Today I'm joined with Zack Porter with Boa Safra Ag Services. Zack, how are you doing?
Doing good. Thanks for having me.
Absolutely. So today we're going to talk a little bit about some of the things your firm does, in particular legacy nutrient deductions. And this is a new space that, I wouldn't say a new space, but a space that some of our clients are starting to evaluate and get into a little bit, as are we. And so your firm is one of the pioneers, if not the kind of go-to service provider for legacy nutrient deductions. So Zack, just kind of starting out at a high level, can you kind of give our audience, our clients, our team, just a brief overview, kind of at a high level on what legacy nutrient deductions are? And then from there, we'll kind of get a little bit more into the details.
Sure. So legacy nutrient deductions are a federal tax deduction available to owners of farmland, ranch land, and in some cases even timberland, that are based on the value of the excess agriculturally necessary nutrients present in a landowner's soil at the time that they take title to the property. The operative theory behind those deductions is that over time and in the absence of good agronomic stewardship, as you produce and harvest a crop or as you graze your acres, you would be systematically removing those nutrients from the soil. And theoretically, because of that, over time, the land would become less productive. But it gets treated just like any other form of accelerated depreciation. So there are no requirements at this point for any sort of ongoing monitoring or practice changes or anything like that. This is simply a one-time deduction per owner of the land that requires a one-time analysis and incurs a one-time cost.
And so typically, Zack, these deductions are best suited for when an owner acquires a piece of property, inherits a piece of property. What's the kind of statute of limitations on your ability to do this? Or, if somebody's already bought something, they want to go back and look at this. Is that something that is possible to do now?
It is. So what we tend to find is there are 4 sections of the federal tax code that CPAs will allow people to pursue these deductions under. Those range from Section 180 over to the broader repositories for depreciation and depletion, which include sections 167, 168, and 611. Each of those behaves a little bit differently from each other. Section 180 is largely limited to properties that were purchased or inherited in the current tax year, where the owner of that land is also actively engaged in agriculture. Now, if you meet those 2 criteria,
one of the keys, right, to all this, you have to continue to be active in agriculture, have agriculture use on the property, correct?
Well, yeah, the land has to be in some sort of agricultural use. Right. But for Section 180, it's limited to stuff that you picked up in the current year, and you as the landowner are active in that agricultural activity. But if you meet those 2 criteria, Section 180 will allow you to take 100% of that deduction in that current year. The other 3 sections of code are far more lenient. they are more applicable when you had purchased or inherited a land, piece of land in a prior year, and or you were either active or a passive participant in that agricultural activity. But the trade-off for those other three sections of code is that unlike 180, where you can take that deduction all in one year, you have to spread the deduction out over a certain number of years. And what we've found is that using those other three sections of code, there can be real value for landowners on land that they had purchased or inherited, in some cases as far back as the early 2000s.
So Section 180, just to kind of clarify and sum that up, Section 180 is allows 100% in the year of purchase or the year of acquisition or inheritance. It's a little bit more stringent to get 180 compared to the other three. If you're in the other three, it's not as immediate of a deduction. It's more spread out, or it's kind of phased over a period of time, but you have more flexibility to go look back to previous purchases, correct?
That's right.
Okay, gotcha. So, in terms of our clients and a lot of your clients, I'm sure 180 is preferable if they can get it. If not, then some of these others seem to be the target.
Yeah, I mean, in general, whenever somebody qualifies for Section 180, they tend to pursue this deduction under that section of code because of the immediacy of the benefit. But that's not always the case. If somebody had a situation where they knew that in year 2 after purchasing or inheriting that property, they were about to experience a very hefty tax bill, they may choose one of the other sections of code just to spread it out and time that. But again, that's a discussion that they would have with their CPA to account for whatever their specific tax circumstance was.
Yeah, the strategy around the timing of deductions, if there is that potential, is something certainly people need to think about and talk to their CPA and attorneys about. So tell me a little bit more about yourself, your background, how you got into this space, how your firm got into this space, and how you all have kind of grown your business across the country, and really interested to hear more your story in terms of getting into this.
Sure. So I've had a bit of a Forrest Gump story myself. Over the last 15 years, I've had the privilege of building and restructuring and investing into various agricultural businesses. During that 08 crash, I ended up getting picked up by an investment firm where I helped them both with their food and ag and their security and intelligence practices. And that led me to develop a thesis in the agricultural sector that said soil health in general was something that had not been fully optimized, both from a farming and ranching side of things, as well as some of the implications throughout the food supply chain. And when I left that investment firm in 2014, I led the independent acquisition of a fertilizer business in the upper Midwest. After that, ended up taking over and helping restructure a food and agriculture focused venture capital fund spanning both the U.S. and Canada, restructuring an operating business and farm in kind of eastern Nebraska. And all of those experiences ultimately led me to think about how to build companies, how to look for areas where you could take your understanding of soil sciences and then build various businesses off of that. I now have a farm in western Nebraska, and I'm one of the owners of Boa Safra here. I actually met one of the co-founders of Boa Safra when I hired him to come work for me back in that fertilizer business around 2014, 2015, and we stayed in touch. And specifically with Boa Safra, we didn't really know about these deductions. My partners and I, until really 2016, 2017, when our CPA retired and the new guy came in and said, "Hey, have you ever looked at these?" And at first we kind of looked at him like an alien.
What are you talking about? What do you mean?
What gives here? But we were curious and we wanted to say, okay, if this thing is real, how do we wrap our heads around it so we could do this on our own properties? At the time, we weren't thinking about building a company off of this.
Right.
And what we found was this really interesting history of this deduction. Section 180 which is one of these sections of code that I mentioned, came onto the books back in January of 1960. And immediately when I heard that, I was scratching my head going, what gives? Why is this not just an industry standard thing? And what we found was there's actually a pretty good reason for it. The IRS didn't get around to actually issuing any sort of guidance on how to pursue these deductions until a private letter ruling that was issued in December of 1991, which again was not broad guidance. That was simply the IRS saying, in the case of this particular taxpayer
case that was brought to us, this is how you should go about treating this, or the methodology around it.
Exactly. So they started to lay the foundation for some broader guidance in how they responded to that one taxpayer, which was then codified in 1995 in their annually produced audit guide, where they said, okay, IRS auditors, here is the standard set of criteria that we want you to make sure that good actors that are trying to pursue this deduction are adhering to, and to weed out bad actors that were trying to take the deduction on land that was inappropriate, or take too big of a deduction, or take it too quickly. So we lost 35 years of being able to use this tool. And what happened in the late 90s and early 2000s is some fairly aggressive taxpayers and CPAs and practitioners started to kind of cowboy this deduction, largely in areas that were small pieces of land with aggressive taxpayers that were largely banking on the fact that they wouldn't get audited because the rate of audit is low. And they were doing this on parcels that were small enough where if they got caught, it wasn't going to be that big of a deal. They'd pay the fine and move on.
Right.
That was not good enough for us. We all operate our farms at material sizes. We are much more conservative taxpayers. And we just said, okay, well, we understand that the codes are real. The work product has some deficiencies that don't meet the standards to get us comfortable to pursue this deduction. What would it take for us to professionalize this? And that triggered a couple of year process, paying very expensive CPAs and agronomists and ag tax attorneys to develop the system that made us feel like we could be much more bulletproof in pursuing this deduction on our own properties.
Kind of a higher standard of threshold to get over to feel comfortable.
Exactly. Something that was actually based in agronomic science. Right? Let's call it what it was. And again, we weren't thinking about starting a company at that point, but you know how the coffee shop goes.
Yeah.
Hey, what's that thing you're working on?
Yeah, right. People start.
Can you help us with this?
That's right.
And today we've kind of become the 800-pound gorilla in this space. We now operate in every single one of the lower 48 states. We've had the privilege of doing this for over 5,000 folks. And over the course of that, we've gotten to see a lot of different interesting situations. And we've, kind of like that insurance company says something along the lines of, we know a thing or two because we've seen a thing or two.
Yeah.
We've kind of earned the right to say something similar in our little narrow view of the world.
The more reps you've gotten to, and I'm sure the more work you've done in different markets, that's also been eye-opening in terms of how to further refine that process to continue to feel comfortable about the things that you're doing.
Exactly. And, again, we know that the IRS audits, folks at about 1% a year. You would anticipate, given the fact that we had done this now for over 5,000 folks, that somewhere in between 5 and 10 of our clients should have been audited. And that is the case, right? So, number one, we know that there's no difference in taking this deduction or not in terms of your rate of audit. And it also has given us an opportunity to see how our work has stood up to IRS scrutiny.
Right.
Of those 6, the smallest pursued a couple $100,000 deduction. And of those 6, the largest pursued over $40 million worth of deduction. And I'm very proud to say that we have a 100% track record of no change rulings on our work. Now, nobody ever bats 1,000 forever, but I think it's a good indicator that we haven't totally screwed this up.
That's right. Yeah. If you've gone through enough of these reps with the IRS and you've had people looking over your shoulder and those have held up, that's give you a lot of confidence moving forward.
Exactly.
Kind of what you mentioned is something similar kind of to how I've felt about it. Is some of our listeners know my background's in accounting, got my master's degree in tax. And quite frankly, I'd never heard of this. And so the first time I heard about it, I was probably a little bit skeptical, like you guys, of just, what is this? Why is this not common? Why is everybody not doing this? What's the story here? And so over, a period of time, I've gotten more up to speed on it, have done a lot more digging into it, and had conversations on our end with our external CPAs and groups that we work with. And I've gotten my arms around it a little bit. And we, on a small piece of property, we did a project with you guys on property that we purchased here in Central Florida. Historically was groves, now in cattle. And so, there's value there, right? I mean, there's, we went through the whole process of soil sampling and testing and kind of the back and forth, and have now kind of read through a finished product report from you guys. And it's very thorough. I mean, it is, you've got your process down, and as a fan of what you guys are doing, but also a consumer of it, I came away very impressed.
Well, I appreciate that. And I appreciate the opportunity to work with you on that project. And that really is, kind of how it tends to go. People start with the same exact questions that we had. What is this thing? How does this work? Will it work for me? Mm-hmm. If so, how do I get going forward? And, we've got the flywheel spinning. So I'm happy you had that kind of experience.
And, you mentioned earlier kind of the comparison to bonus depreciation or accelerated depreciation in other arenas. And on our commercial side of our business, cost segregation studies are very, very common, right? It's the similar theory in that it's, you're getting accelerated depreciation for allocating costs on a purchase to things that have a shorter period of life from a tax perspective, but it's still done at the time you acquire it. Typically, you're basically getting credit for, obsolescence or wear and tear on the existing facility or property that you bought. And so it's the IRS kind of saying, you can accelerate a lot of the depreciation into those early years of your acquisition. And the theory, while the code section's different, while the thresholds are different and everything's different on the, legacy nutrient deduction side, there is probably a general comparison in terms of theory between that and what you guys are doing.
Very much so. A lot of people have started to kind of describe us as doing cost segregations on soils. Yeah. The difference here is, even though the IRS has provided guidance on how to do this, there are still some areas that are left up to a CPA's discretion.
Right.
And we talked about how 180 statutorily allows you to take 100% of the deduction right up front. The other three sections of code are silent on the specific number of years that a CPA should spread the deduction out under those scenarios. Now, what most CPAs have done is they have said, all right, we know that most of these nutrients are getting used up agronomically under most cropping and livestock regimes over somewhere in between a 3 and 7 year period. Mm-hmm. So, okay, if that's kind of the period that most of those nutrients are getting used up over, they will tend to say, all right, let's spread the deduction out somewhere in between 3 and 7 years. Now, within that 3 to 7 year period, there's kind of two camps that have evolved, where you have folks that will say, all right, I am going to actually treat this as accelerated depreciation. And those folks will tend to pick a 3-year 60-30-10 type of way to spread out that deduction. And then the other camp will tend to do a straight line 5-year, kind of right smack dab in the middle of that 3 to 7 year rate, because they're saying, look, we're going to have that track loosely with that usage rate of those nutrients.
So some of the treatment is left up to the landowner's CPA to apply in terms of how to treat a few of those other deductions outside of 180, where there is a little bit more silence or less guidance on the timeline of treating those.
That's exactly right. And then, another thing too, we all know you can't depreciate real assets to zero. Or less than zero, right? That's an immediate red flag. So there are certain parts of the country where land may have a relatively depressed price relative to the value of these excess nutrients, because that land may be limited by water or it may be limited by infrastructure or duration of growing season. And in some of those cases, the market value of land may be roughly equivalent to or lesser than the level of these excess nutrients that are showing up in the soil. Well, CPAs have also come up with a way to handle that, because we all know that at the end of the day, you can't go and depreciate
On a
things.
negative basis. Yes.
Exactly. So what has also evolved is most CPAs will allow a landowner to use up to 50% of their land basis for a legacy nutrient deduction, or LND for those that just don't like saying that many syllables.
So if you buy a piece of property for $1,500 an acre, the CPA and the legacy nutrient deduction is $1,700 an acre. It's more than what you paid for the piece of land. They're only allowing you, typically what you've seen from CPAs and practitioners, is they're only allowing you to deduct $750 an acre, 50% of the land basis of what you bought the property for.
Exactly. So it's kind of something where, again, practitioners have said you can use the lesser of the results of our analysis or 50% of your basis.
Yeah.
And that's just another, again, kind of not from the IRS, but how most practitioners have kind of said, all right, we're going to put some guardrails on this just to prevent people from going too crazy here.
Yeah, absolutely. Where have you seen this be the most beneficial from a real estate deal perspective, right? Like, we work with a lot of buyers and sellers, as I know y'all work with a lot of the different land brokerages and management companies around the country, and lenders and other groups. But where have you seen this kind of make a difference, either in a negotiation or in a buyer's appetite for a piece of property? How does this opportunity kind of play into either deal underwriting or just the appetite from buyers on certain properties?
Great question. And there's a myriad of different ways that we've learned about here. And we keep finding more, the more that we do this too. So I'll kind of list them out into some buckets to help answer the question here.
Mm-hmm.
I don't know a single person that wants to spend more on anything than they have to, right? However, in a competitive bidding situation, if you're a buyer and you know that you can pursue this deduction and you wanted to make sure that you won that bid no matter what, you could walk into that auction room and say, highest bid in here plus my tax bracket. Because as soon as you take the deduction on the back end of it, you're not paying any more than anybody else would have in the first place.
Yeah, the effective purchase price is the equivalent. Yeah,
exactly. So that's kind of one way that we've seen that happen. We're seeing a lot of brokers, time and time again. How many times have you seen buyers and sellers get into a loggerhead situation over something that may be totally immaterial on a deal, and it causes that deal to break or just drag on, which increases the risk of closing?
Mm-hmm.
Well, now you can insert this deduction into that conversation as a way to help close that bid-ask spread.
Yeah, if you're 5% off on from a buyer and a seller, maybe this is a way to get a buyer comfortable with maybe going a little bit higher on purchasing.
Exactly.
Yeah. Correct.
And then, on the seller side as well, this is a real tax benefit that is available to that buyer. So we're seeing a lot of people just proactively say, hey, Zach, can you help us quantify and document what this deduction would be for the buyer going into a sale process? So this can actually be described as a capital asset that would have that depreciation benefit going into the offering memorandum.
Even before you procure a buyer, before it even hits the market, you have sellers who've come to you and said, hey, let's put together somewhat of like a proposal or rough, back of the envelope estimate based on similar properties and things like that, or going through the whole process and then saying, okay, this is something that a potential buyer could take advantage of and use, and let's kind of make sure that buyers are aware of that.
But that's exactly right. And then, it's also totally changed how certain buyers view agricultural land as an asset class. I mean, we all know it's got, the uncorrelated benefits, the inflation hedging characteristics, tied to the commodity sectors, which is why so many people have invested into this asset class in the first place. But we've had the privilege of working with, over a dozen of the largest landowners in the United States at this point. And we've learned a lot from their very sophisticated teams. And we've tried to emulate some of those strategies, albeit on a much smaller scale.
Mm-hmm.
But a lot of the folks that have very large tax positions each year, we just got done working with a client who tends to pay about $75 million a year in taxes from non-agricultural sources. And sure, he could go buy another plane, or he could go buy a new truck or a new boat or a bunch of really fun toys that are actually depreciating assets
Mm-hmm.
that will create depreciation for him. But at the end of the day, he's not building his balance sheet with that.
Right.
What guys like that have started to do is they've said, hey, wait a minute. I could be buying diversified portfolios of agricultural land. And when you look at legacy nutrient deductions plus other forms of depreciation on fence or pumps or pivots and tile and whatnot, you can start to actually become very efficient per dollar of CapEx in terms of overall depreciation that you're getting. And they're now starting to say, hey, wait a minute, as a tax strategy, I need to call my broker and say, I want you to go buy me X amount of depreciation each year in the form of agricultural land. And that has turned into a wonderful boon for the brokers, the lenders, and title agents that are involved in those transactions. So, yeah, we're seeing a bunch of different angles here in terms of how people are using this to factor into their relationship with buying and selling agricultural land.
Yeah, and especially I'm sure on the some of the institutional farmland buyers, if you can going into a transaction, from a cash flow perspective, a effective return perspective, if you can go in thinking we're going to have a pretty significant year one depreciation number, that increases the overall effective return that you have on the property. It's a time value of money play. Things like that too, that I think on that side of it, I could see it being very impactful. And, where I've thought about it in the context of a lot of our clients and team members and things like that is, this is a great opportunity for buyers of agriculture land who have no intention of ever selling it, because you're not going to be lumped into the depreciation recapture. If you go to sell a piece of property in a couple of years, like if you're churning and burning, there's still time value of money benefits to doing this in terms of moving that deduction up and getting more cash in the form of a tax deduction back in your pocket in year one. But still, if you're buying and selling every other year, there is the recapture on the back end. But for people who are just big buyers of farmland and agriculture land who have no end in sight with it and want to hold this thing in perpetuity, it makes a lot of sense to me for those kind of people to come to you guys to look at this.
Exactly. I mean, what we tend to find is, number one, you've bought or inherited your land at some point in between the early 2000s and current. Number two, that land is in some sort of agricultural use,
Mm-hmm.
right? Crops, livestock, doesn't matter. Number three, you got to have enough basis to be able to use enough of the deduction to have it make sense.
Which is where on an inheritance or a purchase, if you inherit property, you step up in basis to fair market value on the date of death from the person you inherited it from. So that's creates a good opportunity.
Exactly. And what we've tended to find, if you're playing that game of limbo of how low could you go on basis, it's about $500 an acre of cost into the land. And again, using that 50% cap that we talked about earlier, in that kind of scenario, your nutrients are going to test higher than the land. The average results are about $1,700 per acre in our experience across the country. So in that $500 an acre basis land scenario where you're capped at 50% per what most CPAs will allow you to use, you'd be able to use about $250 an acre of deduction in that case. Now, if you're in a 40% tax bracket, that would be about $100 of cash savings per acre on your taxes. Compared to the $40 an acre fee that we have, you're still looking at about a 2.5x return, mm-hmm. cash on cash. Now, the more basis you have, the more of that deduction you'd be able to use, the greater that return would be. So Directionally, that's kind of where we see that lower end. And to your point, you have to be able to benefit from the depreciation for this to be worthwhile. So if you're a tax exempt entity, this is of no value to you.
You got to have taxable income elsewhere. Yes. That you need to offset. Yes.
Exactly. So just like you said, if you're going to hold the land forever, you have a taxable exposure. Depreciation probably makes sense as a strategy. This will make sense for you to pursue. If you're buying land and you're planning on selling it at some point, but you're going to 1031 it, then this also makes sense because you're going to keep kicking that recapture down the road. But to your point, if you're going to sell something imminently and you're just going to cash out, probably doesn't make sense for you.
Right. What size? I mean, what's the small end? What's the smallest farm you guys have done this for? Smallest piece of land, and then on the larger end, size wise, just to kind of get a sense.
I think the smallest piece of ground we've ever done this for was a 3-acre parcel.
Nice.
And I think that was over in Arizona. And the reason that we went that small, we typically don't do that. Again, that was a CPA that wanted to test it out on their own land before going and bringing this to their clients, so they could say, "I've done this. I think you should do it too."
Yeah,
similar to you. Typically, what we see is people that have 40s or 80s and up are the folks that will tend to have this really make sense for them. I couldn't tell you at this point what the largest single tract was, but we've done some properties where you could watch your dog run away for 2 weeks straight. Absolute monsters. So as big as you want, I mean, there's no ceiling on that. The vast majority of our clients, I would say, though, are kind of in that 40 to 25,000 acre kind of zone.
Yeah. The traditional window, the normal, you got, family mom and pop operators all the way up to institutional size farmers.
Right.
Yeah.
Yeah. I mean, we've done many that are over 100,000 acres, but again, there's just not that many people that have that.
So what are some kind of misconceptions that people might have about this, right? People have maybe heard about it or they're just hearing about it. And, like me, might be a little bit, not skeptical, but just, I need to get to know more about it. What are kind of the typical misconceptions or hurdles you have to clear with people typically when you start talking to them about this?
Yeah, so I think the biggest one is people tend to get hung up on how can you do this on a property that was purchased or inherited in a prior year where you don't have the soil tests immediately from that point in time. Now, a lot of people are familiar with accounting, and they're familiar with the concept of forensic accounting, where you can look at records to figure out what things looked like in the past. Well, in agriculture, when we're looking at soils, the study of soils is agronomy. We understand how to say, all right, if your soils look like this and you do X moving forward, what will they likely look like? Mm-hmm. Well, forensic agronomy is the same thing as forensic accounting, where you apply that understanding in order to hindcast what things look like in the past. And that's what we specialize in. We are forensic agronomists that specialize in being able to look at soil tests as well as agronomic records, such as fertilizer application and crop production records, or your stocking rates and stocking densities, to do that hindcasting, to accurately and scientifically defensively establish what these excess nutrients looked like at that time of acquisition or inheritance in a prior year. So, we tend to explain to folks, how that works. Again, pressure tested by the IRS. So, we know that they understand how it works as well. And that really is that core misconception. The rest of it really is just general education of people largely still not knowing that this tool is available to them and just having to walk them through how this works, where it can be applicable. And we love that opportunity to help spread the word.
Right. And y'all have done a great job from, educating the broker community. A lot of the conferences I go to, y'all have booths set up and are on panels and, trying to spread the word about this and answer questions and be very kind kind of front and center on some of these discussions. So Zach, so next steps, if our clients, our people, people listening to this podcast want to kind of pursue some of this, in terms of next steps, what's the typical process, and how long does this kind of take from start to finish to finalize?
Great question. So the way that somebody begins to engage with us is by filling out our request for services form. All right. They can either access that at our website, www.boa, B-O-A, Safra, S-A-F-R-A, ag, A-G.com. Or if they have a relationship with someone like yourself and Saunders that has become a partner of ours, they could talk to their Saunders agent, and you could direct them to that request for services form as well. So there's a number of different ways that people can access that. And that form is where we collect your particulars, your name, contact information, legal description of your acres, so we know we're going to do the work on your ground rather than the neighbors, right. all that kind of stuff. And when you click submit on that button at that request for services page, that sends that information to our contracting team, who typically within about 7 business days will input that information into the agreement, which they would then email to that landowner for their review and approval. When they execute that agreement, starts the clock, and 2 things would happen in parallel. First, our soils teams would reach out to schedule a time to come on out and take the baseline soil tests that we need to per our protocols. And in parallel with that, if that landowner was pursuing this on a piece of ground that they purchased or inherited in a prior year, that landowner would need to supply their agronomic records, that fertilizer application and crop production, or their stocking rates and stocking density information for that intervening time frame in between when they took title and when we go to take the soil tests.
Gotcha.
Once we receive both of those sources of information, our analysts would go to work doing the work to calculate what the value of those excess nutrients would be. And typically about 60 days after executing that agreement with us, that landowner would receive that report, which they could then share with their CPA, who would pick one of the 4 sections of code and one of the 3 ways to file to activate that deduction on that landowner's tax returns. Now, the places where that timeline could get dragged out would be in a cropping scenario. If you have already planted, and if you've planted a crop like soybeans, for example, where that growth mechanism is above ground, well, we can't get out into the field and do the testing without potentially damaging that crop. So, if you're growing something like corn that gets tall, once you get into mid-July and it's over knee high, it would be difficult to get into the fields. So in those cases, we would need to wait until harvest to go and do the
seasonal delays just based on the timing and crop season. Yeah,
exactly. So in those cases, what we do is we would say, all right, in the order that people sign up is the order that they would be sampled after the crop comes out of the ground in their area. So even if you're in a situation where you've planted something like soybeans, or you've got a crop that's getting tall, you may be sitting there saying, all right, let me just wait until after harvest. That's okay. But if you want to make sure that you're going to get the results of this done as soon as possible, so you can factor this into your year-end planning, so you can make whatever other tax decisions you need to make, signing up sooner rather than later to hold your spot earlier in line would be advantageous for you.
Getting in the system, getting in the pipeline, getting the ball rolling. Yeah,
exactly.
Well, wonderful. Well, Zach, I don't want to take any more of your time, but I really appreciate you coming on the podcast today. This is a really interesting opportunity for a lot of our clients, a lot of landowners, a lot of farmers out there in the industry. And I appreciate you coming on and telling us more about it, and look forward to talking to you again here soon.
Absolutely. Tyler, thanks for having me. And again, if anybody has any questions about this, they can feel free to reach out to me. My email is Zack, Z-A-C-K, at Boa Safra Ag.com.
Awesome. Great. Thanks again, Zack. Talk soon.
Thank you much.
Thank you for listening to In Our Expert Opinion Real Estate Podcast. Don't forget to subscribe on your favorite podcast app so you never miss any of our upcoming episodes. For more on land and commercial real estate, please connect with us at saundersrealestate.com.